So I'll start out with a little informal observation. You can take it for what it's worth. 1982. See, I've got an advantage over you guys because I was trading in the late 1970s, and some of y'all weren't born. But yeah, maybe a couple of you. Maybe a couple of you. 1982. What happened in 1982 in the stock market? It was August of 1982. Yeah, see? Elephants and psychologists never forget. August of 82.
The bull market began.
That's when the bull market began. We had a wicked bear market that actually hit a price low in 1974, December, if I'm not mistaken. And we hit a secondary low in August of 1982. And then we launched a bull market from a low of, boy, where was the, yeah, it was like 700s, we're 776 or so. Yeah, so, from a low level, we went on a generational bull market. All right, so 1982 was the bottom. We had a momentum liftoff from 1982, and then we rally. We had a dip in 1984 that bottomed in July. I remember these things. And then we hit a top in 1987. What happened in 1987? Crash. Yeah, talk about flash crash, yeah. So in that August to December period, huge volatility. I remember a market going down. Back then, it was a lot in percentage terms, a couple hundred points and like 30% down in one day. But we recovered off that low, and that low held above the 1982 level. So a few years later, we get another fall, another bear move. And what happened 6 years after that bear move? So that puts us to 1993. What happened then? What? Why was late 1993 important? What's that? Well, the dot-com stuff actually started a little bit later in the 90s, although companies were percolating then. 1993, and the reason I'm talking about this is we hit the generational low in VIX. The absolute low in VIX ever was something in the 8.9 range in December of 1993, 6 years after that secondary crash. So what happened after 93? We had a relatively flat corrective market in 1994. We based in February and then late in the year in 1994. And then we rallied in 95, 96 and had very modest corrections, but it was on higher VIX. And then what happens in 97? We start really getting into the dot-com trade, the internet stocks. And then we had the Asia contagion and the crash in 97, and then rallied right off that into 98. And then we had the October decline in 98. When did that bull market end? When did that dot-com thing end? April 2000. Yeah, so exactly. So I know their market history. Yeah, so it was in the spring of 2000. So from 1993, the VIX bottom, to 2000, we had a higher volatility bull market. And that is when the day trading world expanded because of that volatility moving up. Okay, all right. So why do I mention this? We had a bear market end in 2008. And we've been engaged in a generational bull market since then. Why is it a generational bull market? Because interest rates are crushed held artificially low by central banks around the world, and anything with yield gets demand. It's why the risk parity trade has been so successful. Buy bonds, buy stocks, because you're really getting yield in two different ways. And so when stocks sell off, bonds do better, flight to safety, and the combination of bonds and stocks has been a great performer in the crushed yield environment. So we bottom in 2008, and the interest rates start coming down, 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 and we make a secondary low. Remember, 87 was a secondary low, and we made a secondary low when? August of 2011. Remember, VIX jumped all the way into 30s, 40s in that 2011 shot down. But we stayed above the 2008 lows, and 6 years after, that puts us at 2017. We're at a generational low in VIX. We're testing the levels from 1993. Now, I don't know if history is going to repeat itself, but from 1993 to 2000 was a higher volatility bull market, and the day trading industry thrived. Might history be repeating itself? Just as everyone's crying about the algos, just as everyone's saying there's no more opportunity, and they look at the charts and they say the fucking thing won't move. All true, that's what low volatility means. But in the big picture, that low volatility period, 1993, was the cusp of phenomenal opportunity, and we saw bubbles created in the internet stocks, and we're seeing bubbles created now. Something called cryptocurrencies I heard of. Yeah. We're seeing bubbles even starting to creep on the horizon now. So I toss that out provocatively because many times, psychologically, when things look most dim, we are least able to perceive opportunity. I was around in trading in 1993, and no one was talking about great opportunity. In fact, the scars from that bear market were still felt. And here we are in 2017 with record low volatility, and might we be on the cusp of something bigger and better? Food for thought. Okay, so let's talk about psychology of the market. What do we mean by psychology of the market? What we're trying to do is, per Dr. Kepler's presentation and per the profile, we're trying to infer the psychology of market participants. Are they leaning one way or another? It's just like sitting at a poker table, right? You're going to be observing the other players. The great poker players, yeah, of course they know the odds of their hand and they play their odds, but they're also picking up the tells around the table. They're reading the psychology of the other participants. The market is just one big poker table. And you're reading the psychology of the participants. And as you'll see in my presentation, there's a way of reading the psychology of the algorithms that can help us figure out, do we want to bet or do we want to muck our hands, so to speak? Okay, so one of the big questions over here about trading psychology of the markets. First question, who is in the market? This is so important. And we infer who is in the market from volume. When we see volume increasing, what participants are getting involved? So today in the spiders, let's say, in the SPY, we're seeing days where we have 50 million shares transacted. If we were to see a 100 million share day, where's that extra 50 coming from? Who is participating? Larger institutions, and what kind of bias do they have? Are these all new, freshly minted market makers who are suddenly participating? No, these are directional participants. And I see it working at several different hedge funds, macro funds. They are putting money to work in a directional fashion based on their thesis about fundamentals and so forth. So they tend to be longer time frame participants. They tend to be directional participants. So when we have very low volume, and we can run the correlations on this, we have very low volatility. Because there aren't those directional participants able to move the market one way or another in meaningful size. So volume tells us if directional institutional participants are getting more involved or less involved. And that's important because we can be nimble enough to ride their coattails when they are involved. Second question is, what are they doing? If these institutional directional folks are getting involved, what are they doing with their involvement? So we look at, are they leaning to the buy side? Are they leaning to the sell side? And that's where tools, as we'll see, like the market profile, that's where the tools like the footprint come in. We're looking at the distribution of their buying, selling to get a sense of, are they leaning one way? Because once again, we have some opportunity to ride their coattails. Not only what are they doing, but where are they doing it? So at what price level are they jumping into a market or out of a market? Not all price levels are created equally. So if we see bailing out of markets at a price level or a range of price levels, then if that's going to have legs, we should not come back to that range of prices, right? That becomes a significant range. We, in market profile terms, we are rejecting value at that range, at that level, and we're in the process of establishing new value. So where something is happening gives us great reference points, and those reference points are relevant to targets and stops for our trades. Not only what are they doing and where are they doing it, when are they doing it? When I say when, I mean when during the day. One of the great lessons I have learned working at macro hedge funds is that different participants in the marketplace tend to transact at certain times of day. And we're all creatures of habit. So you can look at how prices behave during those times of day to infer who's active. So if you are an execution desk for an equities fund, when are you going to be transacting? Are you going to be transacting at, I don't know, 8 o'clock Eastern in the pre-market? No! There's no fucking liquidity. You're not going to do that. You're going to be transacting because you're trading big size. As I mentioned before, at funds where I work, the minimum portfolio size is hundreds of millions. So you have to transact when the liquidity is there. When's the liquidity there in the stock market? In the open, the first 30 minutes and then late in the day. So they're going to get their business done early. So we want to look to see if they have a leaning by how prices behave early in the day. Now you'll notice, like on days today, if you look at the S&P, we started a move around 3 to 4 in the morning. Who's participating at 3 to 4 in the morning? I mean, I might be awake, but I'm not moving the market. Yeah, London is coming open. And before that, you're absolutely right, Asia. Asia comes in late Eastern time, US. So there are times in the overnight session when you see the influence of the Asia trade. There are times where you see the influence of the European trade. And many of the macro developments, remember, a lot of players, larger players, are trading stocks as part of a larger portfolio of concepts that would link stocks, interest rates, currencies globally. So the US stock market, in a way that never used to happen in the distant past, is now influenced by global macro traders in Asia and in Europe. So I want to see how the Asia traders are lining up in their time frame. I want to see how the European traders are lining up in their time frame and how the US folks are lining up during the liquid times. And you can get a sense of how different participants are leaning simply by segmenting over time. So where are they doing it? When are they doing it? And how are they doing it? What does that mean? We tend to get focused, and I would say tunnel visioned, on the markets we're trading. I'm certainly guilty of that in my trading at times. We're so focused on, if we're trading the index, the S&P, that we don't take a look at how other instruments are trading. If stocks are going up, and we also see the US dollar going up, and we also see interest rates rising, which means that bonds are falling, and we see commodities going up, what is that telling us?
Bull market.
Bull market, and it's a bull market across asset classes. Those portfolio managers are buying risk assets across instruments. So they are acting on a bullish idea about the US economy. And that's going to affect the dollar, that's going to affect utilization of commodities, that's going to affect interest rates and so forth. Now, on the other hand, and by the way, we can use that reasoning for other instruments. It's not just the stock market. You can look at the dollar and how it's trading, let's say, versus the British pound. And it's strong. But then we look at the dollar versus other crosses. Is it strong or weak? If the stock market is going up, but other risk assets are not going up, then we know that's not part of a global macro bullish trade. It's a more idiosyncratic move by stocks themselves. Maybe people are buying stocks because there's some demand for mutual funds. Maybe they're buying stocks because they're short covering, but it's not part of a big macro trade. We don't see that because often we're so tunnel visioned on just the stock market that we don't see the bigger picture of how it's moving relative to other asset classes. If it's moving as part of a global macro trade, is it more likely to have legs or not have legs? Have legs, absolutely. These institutions that are putting millions and millions and millions of dollars to work in macro trades, do they get in and out of the market intraday? No, I don't think so. So they're putting on trades for what they call the medium term. They're holding for periods of weeks to months. So if you see them getting in multiple asset classes, that's a great tell that there's bigger fish getting into the market and that move might have legs, as opposed to an idiosyncratic move that could just peter out once the short covering, for instance, is over with. So these are a few big issues that I'm looking at in trading. Who's in the market? What are they doing? And where, when, how? Because those give clues about who's around the table. Okay, so a few tools to read the intentions of market players. And we've been talking about market profile and market delta. I'm also going to speak of measures of upticks, downticks in the overall market, the NYSE tick. And we're going to be talking about something called event flows, which is one way that algorithms are assessing the sentiment of other algorithms. So that's kind of interesting. It's an algo sentiment measure. Okay, we've been hearing a good amount from Dr. Kepler about market profile, and I wanted to just touch on a couple of points where I have found market profile most helpful for the traders I work with. First, remember we talked about where something happens is important. What are the key price levels? Market profile is a great visualization tool to see where are we getting balance and where are we moving into or out of balance. So it's a great way of seeing which price levels are important. Where do we have value? Where do we have movement within and outside of value? And we can do that on multiple time frames so that quickly we visualize what's happening shorter term, medium term, longer term. Now, why is this important? At several firms where I've worked, we've done research about what makes traders successful. And it turns out that one of the success factors is how people are wired cognitively. In other words, how they process information. Successful traders play to their cognitive strengths. Hugely important concept. We all process information differently. Some people process information very effectively visually. And so having a graphic, such as a profile display, is hugely helpful to them. Other people process information interpersonally, through back and forth, hearing other people and hearing oneself talk. And those people can benefit greatly from joining a chat room like Anthony's. Other people process information analytically. They do research, maybe mathematical research, and they're finding conclusions and patterns through their analyses. All different ways of approaching markets and processing information. Where I find the market profile particularly helpful is for people who are processing information visually and then perhaps sharing in an interpersonal context. You want to find tools that play to your strengths. Market delta, the footprint, where I found it to be particularly helpful is in identifying what's called urgent execution. What is urgent execution? Aggressive. I want to get in. So if I'm a buyer, I'm going to lift offers. If I'm a seller, I'm going to hit bids. Now, if I'm patient, I will work a bid over time if I want to be a buyer, and I'll keep buying at bid over time. But many times, if there's an urgency, something has happened with a news item, or there's a particular development in the macro world, the macro portfolio managers, like the ones I work with, are they really going to be working an order over time? No. They will go ahead, and because it's medium term, because they're looking at a longer time frame, they don't mind giving up that tick of execution. They'll lift the offer, they'll hit the bid. And so you can see in the footprint, Trevor talks about looking within the bar. I used to go out and look within bars too. We won't go there.
How'd that work out?
How'd that work out? Yeah. Actually, it did work out real well. If it didn't work out, I'd still be doing it. My wife's not going to see this video, is she? Son of a bitch. Okay, but you know, Trevor talks about looking within the bar, you know, because you are seeing within each time frame who are the aggressors, who is urgent in their execution, and because these tend to be medium time frame participants, we can ride their coattails. So we are in a range, we're in a consolidation period, we're in a period of balance, as we've just heard, and then suddenly we get some lifting of offers, lifting of offers, lifting of offers from the urgent participants. And if that's happening on increased volume, then we have some idea that larger players now are starting to get the market out of balance. And so we can use the footprint also as a visualization tool to look at the waxing and waning of flows. So if the market's been going up, do we see more urgent buying and lifting of offers, or does that start to tail off? And vice versa with selling. So we can see the flow of the urgent execution. Is volume decreasing, and the proportion of volume that's lifting offers, is that decreasing? That move is less likely to extend than if we see more volume coming in and a disproportionate amount, let's say, lifting offers. Dr. Kepler, I thought, made a very good point when he said you can use the market profile and multiple time frames to develop a sound trade idea. And then you can look within the bars to see the waxing and waning of flows to achieve good execution on that idea. So you're looking for a lining up of time frames. This is one way in which I think the integration of the market delta and the market profile can be quite powerful. Remember what I said yesterday, you have to have strategy and tactics. You have to have the idea, but you have to have a sound way of implementing that idea. And to me, your idea can come from the profile on multiple time frames. Merritt teaches about that at SMB. You know, overlay those time frames, get an idea of when things are in balance, out of balance on different time frames. You develop an idea about maybe moving back into a longer term value area. But then your market delta is giving you the tactics to say, okay, if I want to buy it for it to move into its longer term value area, where do I see some of that urgent execution to tell me that that move is starting to get underway? That's a great integration. And for people who are a little more analytical and will take apart the numbers within the footprint, that can be very helpful. And for people who are visually oriented and seeing the waxing and waning flows, that can be very helpful. Yes, questions to this point?
And one quick question for you. You talked about playing to your cognitive strengths.
That's right.
Have there been any tests that you've used or recommended that you really like for being able to identify what your cognitive strengths are?
Yeah, it's a very, very good question. And there are a number of cognitive tests. And there are some personality measures that also have scales that reflect cognitive style. And that's what we ended up using in some of the research that I did at a couple of the places where I've worked. And the vendor of the research is one of the largest providers of personality research in the corporate world, and they're called Hogan Assessments. So they have some tools that are relevant to that. But if you look in the neuropsychology research literature, there are many more specific tools. Yes?
I've taken the Highlands battery.
The what battery?
The Highlands. You ever hear of the Highlands?
No, I'm not familiar with that.
It's a bit like an ability battery. That kind of helps. Like when I was just weighing trading in general and
Yep.
it tells you design memory, verbal memory, tonal, and a lot of other things. It's
Yes.
interesting stuff.
Yes, yes. It's called the Highlands battery.
Yes.
Yeah, very interesting. I'll look into that. But you're absolutely right. We have different forms of memory. And so some people have a great visual memory, and other people have a great semantic memory. They remember words and concepts very well. Yeah, I have a terrible memory for housework that I have to do around the house. Yeah, so we all have our strengths and weaknesses. But that's very relevant, because if we're studying the market or if we're reviewing charts, we want to play to our best form of memory. So maybe for someone who has a strong semantic memory, talking it out loud, maybe with a peer, a teammate, may be more effective than just reviewing it visually on charts. Other questions or comments to this point?
That might be why a lot of floor traders, like we were talking earlier, they lost their edge when the floor is dried up.
What a great observation here. Yes, the floor trading to the screens was a complete cognitive change. It's a great point. You know, on the floors, you're seeing it, you're feeling it. There was a kinesthetic aspect, right? You know, you're seeing it, hearing it, feeling it, and on the screen, there were none of those cues. The same thing was true when really great poker players started to move to the online poker game. And they got killed in many cases. The skill did not transfer because it didn't play to how they were wired. Yeah, very, very interesting.
But my mentor is 10 times better trader than me, but he made all his success in the pit. So we shared an offers for a brief period of time as he was trying to make the transition. And while I was from the floor, I never had any success on the floor. It was about a 6 or 8 month experience. So I didn't have a lot of the bad habits
Right.
he would have had, which were good habits in a pit environment, but bad if you try to translate in the screen environment. And he would watch me and be like, "How did you see that?" And I thought to myself, "This is the guy that taught me the business," but
Yeah.
he couldn't see it, so it's an excellent.
Yeah. Yeah, there's a guy who emailed me a little while back, and he shared with me that you may know it, and I'm blanking on the name of it. It's an app that translates price action
Price block?
into sound.
Yeah, price block.
Yeah, it was a different name, but probably a similar concept. And so there were different tones for rising price and falling price, and the pace of the sounds changed as the market got busier or slower. And he came from the pits, per your point, and hearing this out loud, he plays that in the background while he watches the charts, and he's able to process the sounds better than what he sees on the screen. And that makes him quicker, just because it's playing to his information processing strength. Yeah?
As screen traders, if we are strong in kinesthetic, any ideas on how we might be able to create some synergy there?
It's a very good question. So for a kinesthetic trader, someone who processes information through their bodies, I'll give you one example. Back in the day, when trading became electronic, I met with traders who preserved their edge because instead of reviewing charts, they maintained their charts by hand. Like, talk about old school. I remember those days. But they purposely maintained their charts by hand and wrote out their ideas, because the physical act of creating the chart and writing out the ideas helps cement the information better. So that would be a simple example of using a kinesthetic ability. Yes?
One thing we did when we brought all our guys off the trading floor, we had standing desks. We had desks that were designed that basically had settings where the desk could be low or high. And it made the transition easier for them because they could be moving and standing. Which
interesting.
actually increased their cognitive ability, had them talking more, communicating better than they did sitting in a chair. That was very successful for us. Not for everybody, but a lot of guys, it was really good.
Thanks, Jim.
Yeah, that's very good. Yeah, so a standing desk, you can be more physically active, and there may be some benefits to that. Let's talk about the NYSE tick, and those of you who followed my blog and my writings know that I've used this as a tool now for many years. So how many people do not know what the NYSE tick statistic measures? Okay, good. Okay, so let's get to the basics. All right, so a stock trades on an uptick or it trades on a downtick, okay? And so if it moves up in price, you're looking at each transaction, and if it transacts at a higher price, you call that an uptick. If it transacts at a lower price, it's a downtick, okay? So imagine an indicator that is looking at the upticks and downticks for every single New York Stock Exchange listed stock at the same time. There's like 3,000 issues, right? Or something like that. Yeah, NYSE has more issues than I have. So by a little bit. So in real time, you are seeing how many net upticks we have across all NYSE stocks versus net downticks. Okay? So you're looking across a broad portion of the market. Now, notice how this differs from the information in the market delta footprint. In the footprint, we're looking at each transaction in a given instrument, like the S&P futures. And we're looking at each transaction occurring at the bid or offer price. In the NYSE tick, we're looking across all instruments, all stocks. And are the trades occurring on upticks or downticks? So it's a buying selling measure, but it also has a breadth element that's built in. And by reading the NYSE tick properly, we can figure out who is in the market and which way they are leaning. So let's see if I can take a look here. I'm going to try to do something. I hope this will work. Put this here. That is the current market. That's the S&P futures over here. And that's on a 1-minute bar. And we're going to put it over here. And let's get in the whole day session so far.
Does this show up on Market Delta, this cumulative tick? Is there a way to?
Yeah, the symbol's DJ tick, I think.
Well, it's $tick on most platforms for the NYSE, and then there is a Dow tick for the Dow 30 stocks that would be either DJ, T-I-C-K, or Ticky, T-I-C-K-I, $TICKI. Right, for the NASDAQ. Okay, so this is good. This is the NYSE tick for today. Here's 9:30, and here we are in the current market, okay? And you see this is on a 1-minute basis, and you see even on a 1-minute basis, we have these periods where more stocks are down ticking, it's negative number, versus more stocks are up ticking. Okay, so we're reading that during the day. Now, how do we figure out what's meaningful? A couple of different ways. First is we look at the absolute values of the NYSE tick highs and lows. If we get values of plus 800 or more, what is that telling us? Lots of buyers, but remember how the tick is constructed. Not only is there a lot of buying, it's occurring all at the same time. Now, how does that happen? That all of a sudden everything is upticking at once. It's because big orders are coming into baskets of stocks, are coming into the stock index futures that are getting armed with the individual issues, and the institutional players are pushing that uptick, downtick measure to a high level. If I'm trading, can I push the NYSE tick up there? No, I don't think so. Okay, so if we get to negative 800 or so, or plus 800 or so, that's a couple of standard deviations above an average value. And that tells us that unusual institutional participation is buying or selling. It's a great tell. what happens if we don't see any extreme values? Like it's 400 here and negative 400 here. What's that telling us?
No institutional players?
Yeah, that it's in a lower volume market, we don't have as many of those directional institutional participants like we were saying earlier. So we started out with lots of buying on the open. You know, we had traded higher in the pre-market, but quickly went down to a relatively low level of buying and selling. So it's become quiet, which is a very different pattern in the tick if we start out with lots of buying and then continue to get big upside tick readings. What would that tell us if we started out with a lot of upticks and we kept getting uptick readings? What would that tell us? What's the first thought that should go through our mind?
Buy.
What's that?
Buy.
Yeah, you're right. You're right. You use any dip in the NYSE tick to potentially buy, but it's giving us a tell as to a,
Potential trend.
what's that?
Potential.
Trend day, yes, yes. Trend days are fun. We like trend days. Trend days you buy in the morning and then you have fun in the afternoon and you sell and take profits during the late in the day. But seriously, trend days tend to occur. And at one shop, I actually participated in research about this. When you have skewed uptick or downtick readings early in the session, remember what we talked about, who participates early in the session? Okay, they're leaning heavily to the buy side or sell side. So that gives you some real indication this could be a trend day, particularly if it's coming after a day or more than one day of selling. Let's say if it's on the upside. Why would that be? Why would we be more likely to see an upside trend day after a day or two or three of selling? Exactly. We got people trapped. And so if we see this kind of upticking and then continued upticking after an oversold condition, we know people are trapped. And that's worth getting in on. And what are people saying if they don't catch that? You know, you get the uptick, and it comes down, and then another more uptick, and people are saying, well, I don't want to chase it. But if you have a candidate trend day, then in fact, it's one of those times where you can trade with some degree of momentum. Now, let me make one other point before we get to questions about the NYSE tick. So I mentioned that looking at the extreme values gives us information about both who's in the market and how they're leaning. Suppose we looked at how much of the uptick readings are above zero and how much are below. We could do that with remember we talked about cumulative delta? We could have a cumulative tick statistic. And what would that tell us? If we're spending more time above the zero line than below the zero line, what would that tell us?
Pressure, aggregate buyers, selling pressure.
More upticks and downticks, more buyers than sellers? Absolutely. And so that gives us some indication of directional leaning, even in a quiet market. Now notice how balanced this has become. So we don't have strong directional leaning here. Again, this is across all NYSE stocks. So we went from big upticking to this narrow balance. Tells me the market's gotten a lot quieter. And unless we get a breakout in the tick, it's pretty balanced. I'm not going to be anticipating a trending move when there's a relative balance among buyers and sellers.
And you could look at delta with this and understand, have the buyers sold, and now they got more ammunition to take it higher.
This guy gets an A+. But Mark is absolutely right. We can use this alongside market delta. We can use it alongside market profile. And we see the upticks, downticks in stocks. We see who is lifting offers in the futures. We see how that fits in the profile. Sweet. Okay.
I usually run a T3 indicator on that.
What's that?
I usually run a T3 indicator on that, and I see exactly where we are. If we're positive, more positive than negative.
Yeah.
And then if it's between 400
Yep.
and any one of those, I don't worry about what direction we're at. But if I'm long, and we all of a sudden start spiking down below 400, I probably want to get out of my long.
Yeah. And that's a good early signal because, I mean, you can think of this as being in balance in a sense, per your point. And then we go out of balance, that could be an early sign. Yes, and particularly if you had confirmation from some of these other tools that we're mentioning over here. So today's action actually is a nice illustration of that kind of balance. Now, I'll mention one other tick-related tool. Just going to go over here for a minute.
Well, this morning when it opened up positive, they still had buy orders from overnight and yesterday.
That's exactly right. That's exactly right. And so what's happening is we're showing a lot of upticks at the open because everything is opening on an uptick, right? But there is another measure here that most people don't know about. This is a tick statistic for all U.S. stocks, not NYSE listed. Every single U.S. stock, the smallest of the small caps, everything, not just large caps. So this captures buying and selling in the smaller caps more effectively than the NYSE tick statistic. But there's also another use for this. This measure of tick looks at upticks and downticks from the market open, not from the previous day's close, per your point. So notice how we didn't have any giant spike at the open, because you're starting to measure upticks, downticks from the opening price. And from the opening price, we actually went down negative. You can see it much more clearly with the US tick. That the buyers, as soon as the US market opened, the buyers went away. And remember, it's happening during those market hours when the bigger participants are involved. They're using this to sell, to take profits. And it's particularly in the small caps. So notice that over here, for up to 1045, we had a pretty good number of downticks. And notice how the distribution of this tick statistic has shifted at around that 1045 time. Do you see that? Those shifts in the tick distribution often are a great indication that sentiment has shifted. And so we would want to see where is that most coming into the market. At 1045 time, after that, we saw some shift. So we'd want to see how are things trading since 1045. Oh, the small caps. You see what happened? That US tick statistic captures in a way that the NYSE statistic doesn't the buying interest in the small caps. So we saw a change of distribution, and we see it happening in the small caps. And let's take a look at the large caps. We'll take a look at the Dow. Oh, not nearly so potent. So the US tick, as opposed to the NYSE tick, is capturing upticks in those small cap names and can be very helpful for people trading Russell and other small cap instruments. Yes?
The extremes on the US tick versus the NYSE tick, are they different? Like, for instance, you have 400, 800,000 on the NYSE.
Yes. There are differences. And it's primarily because many of those smaller cap components don't trade as frequently. And so you don't get necessarily the same level of highs and lows. And that's why I always measure in standard deviation units relative to the zero line. So we're 2 standard deviations above in the NYSE tick. We're 2 standard deviations above in the US tick for that reason.
So you don't use a hard number, you use a standard deviation?
I use standard deviation bands, almost like a Bollinger Band around it. You could think of it that way. And I find that helpful. As you work with these things, you develop an intuitive feel, and you know what are high and low levels. Yes, you don't use the exact same numbers. It's a very good question. Yes?
I have a couple quick questions. First of all, particularly with the NYSE tick, was it transitioned from more of a specialist system to more of an electronic delivery? Have you found that the tick has behaved the same, or have you found it to change its behavior at all?
What changed the NYSE tick statistic is when there was a change in the uptick rule.
Right.
Yeah, and so that did change the average price of the distribution. And so it didn't change how the indicator worked,
Right.
but what constituted an average level ended up shifting.
But the indicator you used continued to behave similarly.
Oh, yeah. I still use this as a tool and believe it carries a lot of information about who's in the market, how they're leaning, and there are different tick statistics. I don't have it up on the screen, but there's a NASDAQ tick for the NASDAQ stocks. There's a Dow Jones tick. So you can look at different segments of the market to look at the upticks, downticks among the components. One more question. Yes?
Yeah, my other question is, like on a day like today, last year there was a lot of this, where the market's up on the day, but the tick is not confirming that. Do you consider that to be divergent activity that you become suspicious of?
Yeah, what will happen sometimes is that the market will be up and the tick is not confirming it because you're not getting very high tick levels, you're not getting a lot of upticks.
Correct.
But, and this is a big but, you may be getting very low down ticks. Very few down ticks, I should say.
Right.
So what's happening is that the market is going up not so much because of the overwhelming presence of buyers, but because of the absence of sellers.
That's where cumulative tick would come in.
That's where cumulative tick is very helpful, very good point, so that the direction may still be bullish, but it's going to be a low volume, low volatility kind of bullish. A market that grinds higher as opposed to one that has some momentum and thrust. Yes?
If you pulled up your tick chart, you pull that tick chart up, all right, right click on your chart and add instrument, tick, $ tick Q. You put both those up there and you can see the different reaction between the tick chart between the NYSE tick and the NASDAQ tick.
So there's a NASDAQ tick.
Yeah, but you can actually throw that chart in there on top of that.
Oh, of course, yeah. And you could look at divergences and so on.
Divergence in the
That's true for all the tick measures. That's absolutely true. Yes.
And that's pretty helpful too.
Yes,
Why are you
yes.
still using 10.0?
What's that?
Why are you still using 10.0?
That's a really interesting question. I find for the functions I use, there was a lot built onto it, but this was simple and it had the functions I used, and I've become fast with it, and so I've stuck with it.
And this is 2000.
I
2000.
That's right. And so, showing my age, but particularly for downloading data, I keep a large database of historical values of these things. So for downloading, I just found this to be simpler to use. And so I haven't, I have a version, the latest version, but I don't typically use that in my day-to-day work, particularly when I'm doing data maintenance. Because it's all the same data. It's just, yeah. And I really don't use many bells and whistles in my own trading. I'll just mention one thing real quickly. We've got to move on. With respect to the NASDAQ tick, the NASDAQ is unusually capitalization weighted. So an unusual portion of the NASDAQ is moved by just a few stocks. And so a tick statistic that shows you all NASDAQ stocks may not totally represent what the average is doing, because the average could be skewed by the Amazons and Apples of the world. So you have to put that into some context.
eSignal does great with tick data, but a lot of the other data carriers don't carry the tick data the same. The way they interpret it is a lot different.
Yes, and I shopped around 4 platforms that covered the information I needed and found that eSignal had some interesting things. I'll show some other things if we have time. Okay, so let me go to our last method for identifying sentiment, identifying market psychology. And this one takes some explaining. This comes out of the quantitative research literature. I call it event flow, but the term that you'll want to Google is bulk volume classification, BVC, bulk volume classification. Developed by some people in quantitative finance. So let me explain to you what bulk volume classification measures. The problem with using uptick, downtick stats or even delta footprint is that with more algorithms using optimal execution platforms, you have less urgent trading. Less of your trading is of that urgent lifting the offer, creating an uptick variety. Now, how does an optimal execution platform work? When they create a model, when an execution algorithm creates a model, what are they modeling? What are they predicting? What are they creating a model of? Are they creating a model of the market 1 minute forward? Or 2 minutes forward? 5 minutes? 10 minutes? To figure out when to execute, what are they modeling?
Where price will be.
Where price will be?
Going forward.
Okay, but on what time scale?
Couple of hours.
Couple hours, okay.
How participants react to the flow or the price,
And how would they gauge that? How participants react to flow. How would they gauge that?
the aggressive buying or selling.
Well, they're trying to get at buying and selling that's not aggressive.
Right, so what they do is if people become aggressive, or if they want to have a footprint that shows no aggressiveness, so that they don't have to show their footprints.
Oh, interesting. Now, it would be difficult to distinguish when is that real buying and when is it
Right.
not, because it would show up on a footprint. Similarly, in fact, the models that they're creating are models of the order book itself. They're not trying to predict the market. They're trying to predict what the order book will look like in the next X number of seconds. Now, why would they be interested in what the order book will look like X seconds from now?
It's all about liquidity.
Yeah, they're modeling liquidity because that will tell them how many contracts they are likely to get filled at the bid if they are a buyer.
Be as efficient.
They'll put into the market just enough contracts to get done at bid price rather than offer. They don't want to lift. And they're doing that continuously through the day and executing over time, buying on bids, selling on offers, modeling order book, and that tells them how much they can put into the market.
So the optimal time of when they have the best chance of getting filled, based on what the book is gonna look like. So if it's there on the bid, I have a better chance of getting filled on it. And now I'm gonna bid.
Yes, well, what will give them a better chance of getting filled is the state of the order book itself. And if they see that there is likely, in their model, there is likely to be a good number of bids in the next seconds, then they can take advantage of that, or offers. Yeah. So they're trying to get a sneak peek of what the order book will look like. They're using their modeling to do that. And that's very computation intensive, and that's why it takes real supercomputing power and why it's not something that ordinary traders normally engage in, but that's how they get good prices for their trades. So it doesn't really show up on the uptick, downtick statistics. The buyer's aggressive and the trade is getting done at the bid price. That's
Won't it show up
tricky.
in volume?
What's that? It shows up in volume because there is a transaction. It shows up in volume once there's a transaction, but the volume is occurring at a bid price. and it's not occurring on an uptick. So you need a tool to figure out how do you divine the intentions of these execution algorithms. And so that's where the bulk volume classification comes in, and what I call event flow. So the way that's done is you think of your ordinary chart, and you've got your y-axis, which is price, and you have your x-axis, that is time. So now we're going to take away the x-axis, and each bar on the chart is going to represent a very thin slice of volume. So in the S&P futures, maybe each bar has an open, high, low, close every 1,000 contracts traded. Okay? That's kind of interesting. You're creating lots and lots of bars in a day. And of course, what that does is it adjusts for changes of volatility within the day. We know that volume in the stock market tends to be high early and tends to be high late. That's the smile pattern. But if you're drawing volume bars, you'll draw fewer bars at midday and more bars early and late. So you are adjusting for changes in the liquidity and volatility of the market. And so how are you going to use these event bars, as they're called? That's why I call it event flow. Well, how do you use these event bars to figure out whether algorithms are leading long or short? Because you can't tell with upticks or downticks. You look at how price is behaving within each thin slice of volume. Okay, let's think about that. So for this thin slice of volume, how is price behaving? If there's a constant buyer at the bid, that's going to keep a floor under price. And we're going to see that within that thin slice of volume. That floor is going to be like have a repelling force. We're going to move in such a way to stay off that floor. So we are they use an algorithm to look at how prices are moving within each bar to classify, that's why it's called bulk volume classification, to classify, is this a bullish bar or is this a bearish bar?
What's the time frame for bar?
So I just used an example off the top of my head. It's not a time frame, it's an amount of volume. Yeah. But they are very thin slices. It could be a few hundred shares for a stock, for instance. But you're creating very thin slices of volume, and you're looking, how is price moving within this slice, within this slice, within this slice, within this slice. And over those slices of volume, you are seeing if there's more bullish or more bearish activity based on how things are moving moment to moment to moment to moment. It's a very clever way of looking at buying and selling leaning, aggregating over very short time frames to capture when there might be buying at bid price, selling at offer price. You can still figure out the bullish or bearish intentions or leanings of the algorithms. Yes, Anthony.
Is it fair to say, Dr. Brett, that it doesn't always then have to do with direction? It could be a down, the price could have went down, but it's a bullish bar in the same time period.
Yes, it could happen because it's how things are moving within that bar. Yes, hypothetically, that could happen where relative to the bar or bars before it, it could be down, but in fact, it's trading in a way during that slice of volume that would classify it bullish.
And that's powerful because
Could be,
you probably
yes.
got everybody else bearish, and that's the reason why it's bullish.
Yes. So you would get information that you wouldn't get from an ordinary chart, let's say.
It's kind of a price discovery tool.
In a sense, yes, that's not a bad way of thinking about it.
Could
Let me
you say
see.
it's a way to look at consolidation as to whether consolidation is a bullish consolidation or bearish? and the chance of a breakout or a breakdown are more likely? See what I'm saying? Like, price is going sideways.
Yep.
But the action is.
Either very bullish or very
flat.
bearish.
Yeah, right. But it's still going sideways. So then
Yep.
if it's bullish action, the consolidation is more likely to break to the upside.
Yep. A very good point, yes. So let's take a look at an example. This is from my own data. This is what I trade off of. So I'm opening the kimono wide, people. Let's show some love. Yeah. Isn't that like naked POC? That's what happens when you open the kimono. Oh man, this is getting okay. But let's take a look at this. So this is an oscillator created off the event bars for the S&P futures. The blue is price and the red is the oscillator. So we're accumulating the buying and selling bars. And this is up to yesterday's close. So that makes it kind of interesting because we know what's happened since yesterday's close. So per your point, Mark, here we're chopping around. Now, you could look at that visually, just the blue, and you could say, well, hell, we're making a lower high. That's the right shoulder, okay? And we could expect the market to come down, just looking at that visually. But in fact, what is the classification indicator telling us?
Strong pattern.
Yeah.
That they're selling it and it's not going down.
That's right. There is a lot of selling pressure here, just like here. But how far can the sellers push it down? Not much at all. And so, this is what I call inefficiency. In an efficient market, the buyers or sellers can move price quite a bit. In an inefficient market, the buyers or sellers can't move the market. This is meaningful selling. It can't move the market lower. And you got to ask yourself, and I was asking this question, it was interesting last night. I was looking at this and I was saying, if this can't move the market lower, what is? Maybe if there was some terrible news event, but what's going to move the market lower? And sure enough, how did we trade in the pre-market hours? Yeah, we got a nice bounce and we traded up to peaks up here. And in fact, this measure bounced up. Okay, so what I like to look at is not just the overbought, oversold levels here, but how is it affecting price? One other thing with the event flow measure. Remember I talked about shifts in distribution? Look at that. Look how much we had in terms of selling pressure here. Net bearish bars. But how much was it really able to push price lower? You keep getting selling. Price is not going lower. These people are trapped. And that's what led to this. You can see it in front of you. The bearish sentiment could not move price lower. The bearish sentiment could not move price lower. So this is something that you can observe with this tool. And who's writing about this tool? Who's using this tool? It's the quants. They're published papers. I'm not giving away any secrets. This is published information. You can Google bulk volume classification. You'll see these tools. This is something that the average trader just knows nothing about because it's in the quantitative finance research literature.
What is that again, Brad?
Was what?
Quantitative research, I didn't hear.
Quantitative finance research literature. Yeah. But if you look at research papers in quantitative finance, you'll find all sorts of tools that they are researching and publishing because many of the top people in quant world, in quantitative finance, are also professors. They teach at academic institutions, and so they publish their research. They don't give away all their secrets, but they give away enough about their methods that you can do a little reverse engineering. And this is my simplified version. This is not the tools that the actual quant fund may use. But for me, it's good enough for, for government work. Yeah?
Your data there starts around mid-June, I would
Yeah,
guess?
yeah. So so this is actually the x-axis is just by number of bars. Yeah. So.
But is that just approximate?
Yeah. So yes, and you can do it over different time frames, and in fact, you can do different oscillators. Okay. So it helps to see shorter time frame, longer time frame, just like you would in a market profile. Yes.
And your y-axis for your red, you're looking at each bar. You're looking. Is it kind of like the delta? You're looking at
Yeah.
the transactions that have been.
Yeah. So the net number of bullish bars over bearish bars over. Well, yeah. So it's just a simple oscillator. Yeah. This is not rocket science what I'm presenting, not in the least.
So Brett, who's using this?
I am.
Who's using this?
I am.
I know you are.
And I know quantitative places using that, but if you look at what discretionary traders are talking about on StockTwits or on whatever the forums may be, I just don't see it being used. This is genuinely unique information, which is why I'm sharing it here, because I feel a commitment to offer value to those who, like Anthony says, have taken their time to be part of this.
So you're saying your red bar differs from delta because you're capturing the algo action?
Yes. Now, it would be interesting to put them side by side because there is still significant aggressive buying and selling. And in fact, that is what tends to happen at the hedge funds where I work. But the optimal execution platforms from the algorithmic participants are executing on a different basis, and it's possible to catch their flows as well. So it would be interesting to look, you're looking through different lenses. You look through the lens of the profile. You look through the lens of the NYSE tick. You look through the lens of the event flow, and they're all giving you perspectives. And when those perspectives line up, I think it might be telling you something. Yes?
Well, how do you get access to like that? And did you have to like build it into Excel? Is that how you use it, or is it something that you have?
I program all my own Excel stuff, and I download it from my platform.
So, but there's not like your platform doesn't have that indicator.
There are no platforms that have that indicator.
So
None, zero.
You just downloaded data into Excel.
I download data, and you can automatically download their or utilities that allow you. Okay, but yes, I'm downloading every single day and creating this.
And you built that, okay, so that's how.
And I built it myself.
Okay, cool.
Yeah, I spend a significant amount of my time creating unique measures to figure out what the market is doing. This is one of those measures, and I think it's an interesting one because it does come from real research in quantitative finance.
And if we look, and if like I go up and I look that up and find the papers and stuff like that, they have the equations and how they build it.
Well, they're not going to give away intellectual property, like the specific algorithm that tells them where it's bullish and bearish.
But you can figure it out, essentially.
I was able to figure out a version that fit my limited mathematical capabilities.
Oh, okay.
Yeah. Yes, and I'm sure there are many more sophisticated ways of doing it than what I'm sharing with you, but this is what I've been using.
Did you
Just
just
a
use like
couple-
JSTOR or something?
What's that?
Like, did you use like JSTOR or some academic paper website to find those papers?
No, I know people who publish just because I work in that area. So I know who's doing good work and who's not.
Okay.
Yeah. I work with some firms that do this kind of work. Just a couple of other measures I thought I would put up here. So what's this? So this is telling us what percentage of all U.S. stocks, small cap, big cap, are trading above their VWAP for the day. Now, how cool is that? Every single stock, yeah. So is it trading above VWAP or below VWAP? And what's happening during the day? We're getting, it starts out, we traded the opening tick, of course, nothing, they don't have a VWAP yet. And so we're tracing what percentage of stocks are above, below VWAP. Remember, we looked at that 1045 level. So early in the day, actually less than half of stocks were trading above their VWAP, which said that off the early highs there was selling. It wasn't continuing, but look at what's happened since then. We've broken out to new highs over 50%, and that's because of those small caps that we took a look at that were so strong. So this is just another way of looking at strength and weakness across the entire stock market, and as you might expect, on trend days, what's going to happen with this measure? It's going to be consistently above 50 the whole day or consistently below 50 the whole day. Because if you think of a trend, VWAP is declining, and yet the majority of stocks are trading below their VWAP.
What time of day does this become useful? Like, first minute, it's not useful.
No, it's not useful. And it's useful where you see an inflection point or a potential inflection point occurring in the market, and you're looking at where that's occurring. So over here, I was noticing that even though we had opened strongly, these are low numbers for a strong open. So right away, that was giving me some information. So the first couple of minutes, no. But this is all giving me some useful information. The fact that it's getting stronger here is giving me information. The fact that we had a dip in the tick, the upticks, downticks, and we're still right here above the low here, that's giving me information and so forth.
I like, if you look at my laser pointer, when it breaks out through these highs here, it comes up, where does it come back down to?
Yep.
Where it broke out through those highs.
Right.
That's good stuff, though.
Yeah, very, very good stuff. And I think that putting these things together, the tools that we're talking about, can give you a more rounded version of what's going on in the market. And when they line up, you have some potential high conviction trades. Now let me just mention a couple of other things before we wrap up and go to questions. And a little creativity exercise. Okay, so we talked about volume bars. Let me ask a creativity-based question. What is the volatility of a volume bar? Think about volume bars and the volatility of those bars over time. Now we know that in the market overall, volume correlates very highly with volatility. If we have more volume in the market, then we're going to have more volatility. But what if we're drawing volume bars? What's the volatility of that time series going to look like? Turns out that's a very useful measure. But notice how it's a different way of thinking about volatility. This is what I see successful traders doing. They are looking at new and different data, and they're looking at old information in new ways. So this is an example of looking at volatility in a new way. Because when we have the volatility of volume bars, we are looking at how much movement we have per unit of volume. In other words, when a certain amount of volume trades, how much can it move the market? That's a very interesting concept. I call it pure volatility as opposed to standard volatility. And it turns out that if you were trying to create a trading system, one of the inputs that is often helpful in that systematic trading is a measure of pure volatility. That when pure volatility rises, we tend to have more bullish forecasts for our prices in the S&P. And when pure volatility is low, we tend to have more reversals. When pure volatility is high, when each unit of volume is giving us more volatility, we're more likely to have momentum in the short-term trade. So I toss that out as an idea you may potentially play with. Yes, Merritt.
Have you studied that or know someone that has as a function of liquidity?
Studied
Your pure volatility
as a function
as a
of.
function of existing liquidity.
Yes,
It seems
and
like
so
that would
in
be
low,
parallel.
in low liquidity environments, when liquidity dries up, then you have a lot of whippy movement, and it's because of the state of order books at that time.
Yes.
And so your measure of pure volatility goes through the roof. Absolutely through the roof. And so you remember how people were saying we get these big sell-offs and then the market will just rally? In those big sell-offs, the pure volatility is going through the roof because you're getting a lot of movement per unit of volume. And the reason is because market makers are stepping back, the order book is becoming thinner, and so each unit of volume can move the market more.
And at those periods of time, would that tool, in your mind, be less of a predictor, less reliable? It's just something where it's let's hold off and wait for more normal conditions?
At least historically, with respect to recent history, the tool has become a great buy indicator when it goes through the roof.
For a certain time frame, can you bring this down to very short time frames?
Very good question, and I have experimented with that. And yes, that.
And how accurate are you finding it on the shorter time frame? Maybe less accurate or still good?
It provides information, but I haven't studied it enough to say this is a go-to measure. But definitely when we have cycles in the market, short-term cycles, you'll see that pure volatility on a short-term basis will go down, will be reduced as we're topping out in the topping phase of a cycle, and then we'll pick up as we pick up to the downside, and then we can get some bottoming, and it can come down, and we get some movement to the upside. But that's not something I've studied extensively, but definitely worth looking into. Yes, I'll take one more question because we got to get through. Yeah.
This might be a stupid question, but is that the same thing as exposure to volume?
Exposure.
Like exposure or transmission to volume? Like how many people are actually buying or selling according to the total volume, or no?
No, I don't think so. I don't think it's related to total volume or a proportion of volume. I think it's related to how volume impacts order books. That's my interpretation. So if you have a very thin order book and you get some volume lifting offers, you're going to lift several levels potentially. You know, it's a little bit like the creating tails on a market profile chart that Dr. Kepler talked about. So in those less liquid order book conditions, the volume can move price more. If you have a very thick order book, then it's just going to like churn like that. But definitely something worth studying. But the big point is not that you should use the same indicators that I use. I'm pointing out different things that I look at. In fact, these are all measures. You can see on the left here, these are all measures that are up on my screen all the time. Why do I have the sector ETFs? Because I want to figure out when are we having a rotational trade and when are we having a trending trade. If we have a rotational trade, some sectors will be up and some sectors will be down. This is all measuring change from the market open. So if everything is moving up or everything is moving down from the market open, that's more likely to be a trend trade. And when we see sectors doing different things, it's a more rotational trade. So that's why I have those pieces of information up. $ ADD, that's the advanced decline line. Intraday, how many stocks are making new highs and new lows for the day session? These are all indicators that people typically don't follow that say something about the strength and weakness of the market over time. What do we have over here? 0.82. This is the put-call ratio for all listed options for all equities, but not indexes. And it turns out that that number has a real impact and reflects sentiment. So all these are relatively unique measures. And my big point is that you find your edge by looking at unique information or by looking at old information in unique ways. If you were mining for gold, you would not start digging where everyone else had been digging. You would either find a better way of digging in the same place, maybe that can go deeper, or you would start digging in other areas. And so what I'm trying to point out with the psychology of the markets is that there are many unique ways we can look at sentiment and many unique pieces of data that can help anchor good decisions for us as traders. Okay, I know we're moving on in time, and we've already taken a number of questions, but I just want to make sure, are there any other questions before I toss out one other component? We okay with time?
Yeah, we're good. You could go over, Brett, don't worry about it.
Okay, I'll just by a little bit. Okay, any other questions before I launch in? Okay, so just as a little example of creativity and thinking about old things in new ways. Let's see if I can pull something up here. So what do we have here? This is the E-mini price in blue. And this is a short-term overbought, oversold measure. But now we're looking at overbought, oversold in a unique way. So this is where the creativity comes in. I spend many hours a week creating new measures and looking at new data series, and probably 80% of everything I create and 80% of everything I look at fails. And, it's all good because markets are relatively efficient, but once in a while you find some things that are worthwhile, that are truly unique, that other people aren't doing. So this is something I call the power measure, and this is on a 40-bar basis, and these are event bars. These event bars are drawn a little differently from the other ones. These are not volume-based. These are based on price movement itself. So every 500 price changes in the S&P, it draws a bar. That's kind of an interesting concept. Every 500 price changes, a bar occurs. So it's based on the movement of the market, not the volume traded. Okay? And so in the power measure, we are creating a correlation. It's a rolling correlation between the price change of the bars during that period and how it's correlated with the volatility of those bars, or the size of those bars. In very simple terms, what we're looking at are these event bars, and do the big bars tend to occur when the market's going up or when the market's going down? That's all we're looking at, okay? We're creating a correlation measure that says if it's positive, the bigger bars are occurring when we're going up. When we're negative, the bigger bars are occurring when we're going down. So it's telling us who is moving price more in that unit of event time, the buyers or the sellers. What happened here at yesterday's close? What happened? It's the same pattern that we saw in the event flow. Remember how we saw that selling and it couldn't move the market lower? Lo and behold, look at all the selling, not able to move the market lower. The same pattern is showing up in two different measures constructed totally differently. So I toss this out as an example of how we can be creative to look at new information, look at old ideas in new ways, and find potential sources of information and edge. each of you looks at certain information to find your edge. What I would challenge you to do going forward is to think of better ways of processing that information that you're already using and other sources of information that you could bring into your trading that might help you measure the same thing or the same thing better, ideally. And notice how I'm using my platform my data platform to feed me information that helps me construct these things. Yeah, Merritt and then Mark.
Just your general process for, you mentioned, like all of us, 80%, all our new ideas suck.
What's that? I'm sorry.
I'm sorry. You mentioned, 80% of them don't work, your
Yep.
ideas and these kind of things. That's normal, that's great. What's your general process for literally determining success or failure of one of these ideas?
Yeah, so that's a very good question. How do you know if something's working or not? So I first take a historical look. And would it have given meaningful signals on a historical basis? And sometimes I'll actually do statistical tests. Do we show, for instance, at oversold levels, do we show more positive forward price movement than at overbought levels? I might do that analysis statistically. But I'm looking historically, did it give meaningful signals in the past?
You're also using Excel for that testing when you do that?
Correct.
quantitatively?
Correct. Yep. And then, if it's giving some meaningful signals from the past, do those signals make sense to me? I want to make sure I'm not just seeing random patterns and making something out of it. So is there a rationale why this is working in the past? If so, if it's making sense, it's worked in the past, then I'll follow it on paper going forward and see if it's giving me some useful signals. And if so, then I'll put it in play with other measures that I take a look at. So there's a whole development process, but it really has to prove its worth. It's easy to get fixated on the latest shiny toy, and so I have to make sure that it proves itself over time and doesn't bias my decision-making processes. Yes?
Do you have any suggestions on how to process cognitively all this information? Like, we have these indicators, we have market profile, we have market delta, we have stuff like this. But if you're not sort of organizing it all in a way that it's useful to the trader,
That's right.
they can easily tap in and draw good conclusions. Like, do you have kind of like a framework that you would suggest? I don't care about the actual indicator, but more how you would frame things so that you can then use it effectively and not jump to conclusions, but like a progression.
Yes. So there are a couple aspects. It's a great question. And this gets at the heart of creativity. When someone is creative, what they're doing is analyzing something in detail. They're looking at the market in different ways, collecting lots of different information. They're analyzing. But as Mark is pointing out, to really make use of that in trading, you can't just do the analyzing. You also have to synthesize what you have just looked at into a coherent view. And so you need to have the information available in the easiest to digest ways possible. Now, I happen to not be a visual learner particularly. Someone can show me charts and pictures of things, and that doesn't do anything for me. If you show me a spreadsheet, and I look at the columns of the spreadsheet and how things line up, I can tell very quickly if something is likely to be statistically significant or not. I think in those kind of terms. And so, for the information, for me, to be downloaded onto a spreadsheet makes it user-friendly for me. And yes, I can chart it from the spreadsheet, but I have it right in front of me in a user-friendly way. Other people will do it in a charting way. But you need the relevant information in front of you at the same time in a digestible fashion. That's why we have multiple screens. That's why we have multiple data feeds. So you're seeing it all in front of you in real time. That's necessary for efficient analysis. So you can go from one to the other to the other. Just like if you were looking at the macro trade and you see what stocks are doing, and then you look over at commodities, you look over at currencies, you look over at fixed income, you have multiple information coming in, playing to your cognitive strengths in a way that you can digest. But then, once you see it all, you have to step back from those screens and say, what does it all mean? What's this pattern here? That's the synthesis. Are things lining up? Are they not lining up? Maybe they're lining up on one time frame, but not another time frame. So there is a thought process you use to integrate the information. You don't just trade off a pattern in one or two or three things. You are integrating it into a coherent view. And that's the essence of what I was calling the strategic aspect of trading, coming up with an idea. The idea we are synthesizing in a creative fashion from multiple data sources. And then the tactics are how we implement that idea.
You could have a bad idea with a good strategy and tactic, and it's not going to work. Just like you could have a good idea with a bad strategy and tactic, and it's not going to work. So you got to kind of go from your idea synthesis to then strategy tactic. And you can't sit there all day with the strategy formulation and the tactic, right? Because the market's already moved.
Well, I would argue that the different sources of information are providing you the basis for a strategy, and that then you implement that in terms of tactics.
Not your idea.
What's that?
See, I'm looking at, you have an idea. The information helps you generate an idea. But then you need a strategy and
Implement
some
the
tactics to implement.
Yes.
Like the strategy is not necessarily the idea, is it?
I would argue that it is.
Okay,
Yeah, but we're using the terms differently.
You combine it,
Yeah.
which makes it.
Yeah, yeah. The idea is the strategy. The tactics is how you implement the idea. Yeah. That's how I was using those words. But in terms of making use of this presentation, I encourage you to think about the different things I presented, to think about how you are creative in looking at markets, and particularly how are you capturing the psychology of the markets you're trading. A big, as I mentioned yesterday, a big proportion of winning trades comes from buyers who can't move the market higher, that's the inefficiency, and they have to get out of their position because they're over leveraged. And sellers who can't move the market lower, they're trapped and they have to cover because they're over leveraged. A big amount of the opportunity in markets comes from that dynamic, and these measures are simply ways of capturing when are sellers dominant, when are buyers dominant, when are they able to move the market, when are they not able to move the market. And when you see the dynamics occurring across different measures, that gives you some confidence in an idea that will anchor your trades. Thank you for having me, and I look forward to staying in touch.